All right, welcome everyone. My name is Tim and I am the Series Ninja. And today I am here to present to you the bond seesaw. So the bond seesaw is going to help us to understand the way that interest rates rising and falling is going to impact the price of an existing bond. Okay, so the key here is this helps us to understand how current interest rates impact the price of existing bonds, which would be bonds that have already been issued. Okay, let's jump into it. Okay, so let's go ahead and draw out our first seesaw. So the seesaw always starts with this thing in the middle. We call that the nominal yield. The nominal yield can also be referred to as the coupon rate, or I like to call it the bond tattoo. And I call it that because this is the only yield that is fixed on the bond. It is fixed when the bond is issued. Bonds are usually issued at current interest rates. So whatever that coupon or that nominal yield is, that thing is going to be tattooed on the bond, and that will not fluctuate. Okay. Now, the left-hand side of the seesaw is going to represent the price of that existing bond. And the right-hand side is going to represent where current interest rates are. Okay. So that represents the bond yields, and we'll talk about the different yields, but I want you to interpret the right-hand side as that's where current interest rates go. Because remember, this bond is issued with a fixed interest rate, that tattoo. But throughout the life of the bond, interest rates are going to rise and fall, and that's going to cause the price to increase or decrease. Okay. All right, so when a bond is issued, the seesaw doesn't actually matter. It's simply a flat line. Now, the reason for that is when a bond is issued, it's generally going to be issued at par value. For the purpose of this example, we're going to go ahead and assume par value is 1,000. Okay. And then bonds, when they're issued, they're generally issued at current interest rates. Now, remember, I mentioned the right-hand side represents your yields. So let me go ahead and introduce those yields to you. We have current yield, yield to maturity, and yield to call, YTM, YTC. Okay, very important. You need to understand the order of these yields. They always go in this order: nominal, current, YTM, and then YTC. All right, an easy mnemonic device to remember that order is never chase market calls. Okay, all right, let's go ahead and throw in a real bond quote and let's build our first seesaw. All right, so this is what a bond quote looks like. Apple Inc., 5%, 36. What does that mean? Let's break it down quickly. Apple is the issuer. The first number preceding the issuer is always the coupon, the bond's tattoo. So that 5%, that's the coupon rate. And then the number preceding that is always going to be when the bond matures. So this bond matures in 2036, so we're looking at a 10-year maturity on it. Okay? So to build our seesaw, the very first thing we need to do, we need to pull out that coupon and we need to establish it there in the middle. So everyone, the nominal yield is going to be 5%. All right, so we have established our bonds tattoo. That's going to be 5%. Now remember, bonds are generally issued at current interest rates. All right, so what we're going to do on the right-hand side, we're going to establish that 5%. That's what that level is. Okay, now let's get into it. But before we do that, let me quickly introduce to you the formula for current yield because you may need to calculate this. The formula for current yield is annual income divided by current market price. All right, we will do an example to show you exactly what that means. All right, let's run through a scenario. So you bought this bond brand new from Apple with a 5% coupon, but a couple years down the line, you decide that you need to sell it. You cannot wait until 2036 to get your money back. So now when you go to try to sell it, you're going to sell it in the secondary market to another investor. But that other investor has other options. They can buy brand new bonds from Apple at whatever current interest rates are at. So we need to figure out what our current interest rates are at. All right. So let's assume for the purpose of this example, current interest rates have risen. Let's say specifically they have risen to 7%. So now what we're going to do, we're going to go ahead and draw our sloping line. Well, in the question, they told us that interest rates rose. So we're going to start on the right-hand side because that represents the interest rate. We're going to put our check mark above the 5 because interest rates are now at 7. And now we draw our line sloping downward. Okay. Now, what can we interpret from this seesaw? We can interpret that the price is trading below par. We like to call that a discount. So this bond is trading at a discount. Now, for the purpose of this example, let's go ahead and just assume that price is $850. Okay. Now, let's go ahead and interpret some of those yields. So remember, the order of the yields always goes, never chase market calls. Well, we already have our nominal established in the middle. Then the CY, then the YTM, and now lastly the YTC. So what we can see from this is that all of these yields are slightly higher than the nominal. And why would that be? Well, let me go ahead and explain. First off, what is current yield, everybody? It is annual income divided by current market price. So if I, an investor in the secondary market, am interested in buying your bond, well, everyone, how much income does your bond pay? Your bond pays $50 in income per year. How is that? Because it's got a 5% coupon. The coupon is always times par, and that's how you determine the annual income. That $50 is not going to fluctuate. This bond will pay $50 per year every single year up until 2036. So make sure you understand that. The coupon is fixed, and that means that coupon payment will also be fixed. Okay, and again, it's an easy calculation. Simply take the nominal, the 5%, times that by par, and that is always going to be your coupon. So if I buy your bond, everybody, I'm going to go ahead and get a $50 coupon. But in reality, for me, the investor, that's not 5%. Why is that? Because if I buy your bond, I'm buying it at a discount. I'm only paying $850. So if I were to do a calculation to determine how much income your bond is actually going to pay, it's going to pay me 5.88%, 50 divided by 850. All right. So that's why I'm kind of interested in your bond. Remember, Apple is issuing brand new bonds at 7%, and I can get that brand new bond for $1,000. You're trying to sell me your bond. Well, your bond stinks. It's tattooed with a 5% coupon. I don't want that bond. However, if you drop the price, well, now that yield of 5.88 is getting a little bit closer to 7, okay? But it's still not 7, so why would I want your bond? Well, let's interpret some of these other yields, okay? Now, just to recap, the CY, very important. The CY represents the income that this bond is going to pay me as an investor. It's an easy calculation to do, as you just saw. It's not the most relevant of these yields, though. It simply tells me the income that I'll receive if I buy your bond. All right, so let's go ahead and talk about some of those more relevant yields, the YTM and the YTC, because these are the most important to an investor depending on the scenario. All right, well, as we discussed, the CY represents the income. So what would the YTM represent? Well, it's going to go ahead and represent the yield that I'm going to get if I hold your bond until maturity. So we've just established that if I buy your bond, I'm going to get an income yield of 5.88%. But let's think about this. If I hold your bond until maturity, how much am I going to get back at maturity? I'm going to get back $1,000 at maturity. All right, because when a bond is issued, it's always issued at par. And then when it matures, it's always going to mature at par as well. All right. So if I buy your bond, remember, I'm buying it at $850. That means that I will get back $1,000 at par. So I'm going to make a capital gain at the very end of $150. So that is why my YTM is higher, because it represents the 5.88% on the income plus $150 capital gain. Now, I do not get that capital gain until maturity, so I do have to hold it for a few more years, but that is a more reflective yield. Now, on the exam, they cannot actually make you calculate the YTM. You need a more complicated calculator than you are given. However, they will make you interpret it, so you need to be able to interpret that for a bond trading at a discount, that YTM is higher than the CY. And why? Because we're not only getting the income of 5.88, we're also getting that $150 capital gain, okay? All right, now the last yield to go ahead and interpret on this seesaw is that YTC. Well, the YTC is the highest, and why is that the highest, everyone? Well, what's the YTC stand for? Your yield to call, which means it's the amount of money that you're gonna make if the bond is called. All right, so it's very similar to the YTM. The only difference is more the timing of when you're going to get that $1,000 par back. All right, so in the case of this bond, if I go ahead and buy it at $850, I'm going to make that $150 capital gain. In the case of YTM, I have to wait until 2036 to grab that. But if the bond is called early, which would never happen because this bond has interest rates that had risen, all right, we don't call a bond if interest rates rise. Issuers do not want to pay more in interest. They only call a bond when interest rates drop. So in reality, my YTC is kind of irrelevant in this scenario, but nonetheless, let's interpret why it technically would be higher. It would be higher because of what's called time value of money. In either case, the YTM or the YTC, I'm going to go ahead and get 5.88 on the income, plus I'm going to make that $150 capital gain. And so the only difference between the YTM and the YTC is that on the YTM, I've got to wait until 2036 to grab that $150 capital gain. But if it's called early, I'll grab that $150 gain a little bit sooner. And so my yield is higher on the YTC. All right, just related strictly to time value of money. Okay, right. That is the first scenario, and that's for a bond trading at a discount where interest rates have risen in the market since the bond has been issued. Okay, let's run through another example now. All right, so let's go ahead and draw one more seesaw just to make sure that this is all making sense. When we start, what do we start with, everyone? We start with our nominal yield. That's what goes in the middle. That's the bond's tattoo. Now the left-hand side, that represents the price of the existing bond. The right-hand side, that's going to go ahead and represent those yields that we just discussed. But the way I want you to interpret the right-hand side, think of it as that's where current interest rates have gone. Okay? All right. So now, when a bond is born, the seesaw doesn't matter. It's always a flat line. Why? Because it's issued at par, which for the purpose of this example is 1,000. Now the right-hand side, that's where our yields go. Remember, the order of the yields always goes nominal, CY, YTM, YTC, and we can remember that with the mnemonic device, never chase market calls. All right, let's throw in the bond quote. So, bond quote, Apple Inc. 5%, 2036. Well, remember that 5, that's the coupon. 36 is the maturity. So where does the coupon go? Right in the middle. That's the bond's tattoo. And then we can also assume that the right-hand side, the baseline is going to be 5%. Okay? All right. Now, let's go ahead and remember current yield. That's the one formula that I do want you to remember. It is annual income divided by current market price. Okay. So in the first example, what I told you that interest rates had risen. So we were working on the right-hand side of the seesaw. But now let me go ahead and give you a different example. Let's say instead of interest rates rising, now instead the price has risen. So if the price of that existing bond has risen, that means we're going to be working on the left-hand side of the seesaw. And the price has risen, it must be above par. So we're going to say that this bond is trading at a premium. Okay. Now what amount is the premium? Let's go ahead and just assume 1,150. All right. So now the way that we draw our seesaw, well, instead of starting on the right-hand side where the interest rates are, we're going to start on the left-hand side and we're going to draw our check mark there and draw it sloping downward. Okay. Now, what can I interpret from the seesaw? Well, I can interpret on the right-hand side that interest rates must have fallen since this bond has been issued. Let's go ahead and assume new interest rates are at 3%. So now let's think about this, everyone. Apple is issuing brand new bonds at a 3% interest rate, and those bonds cost 1,000. Well, your bond is tattooed with a 5% yield, a 5% coupon. That's really nice, which is why you can sell your bond at a higher rate. Okay. Now let's also drop in those yields: CY, YTM, and YTC. All right, so let's go ahead and interpret a little bit on why these yields are lower than the nominal. Well, everyone, if I buy your bond, how much income is your bond going to go ahead and pay me? Your bond's going to pay me $50 per year. But in the case of your bond, I'm not buying it for 1,000, so that 5% nominal yield is misleading to me. I'm buying your bond for 1,150. So what that means is my current yield would be 50 divided by 1,150. Or 4.34%. Okay. Again, your bond is paying me $50, but I'm not buying it for 1,000, which is why for me, the more relevant calculation is the CY, not so much the nominal yield. That's kind of misleading. I wish I was getting 5%, but I'm buying your bond at a premium. So that is actually 4.34%. Now that just represents my current yield, which again, that's the income component that I'm going to get from the bond. Well, now we can also notice that the YTM and the YTC are lower. Well, why would that be? Well, remember, what's the YTM? It reflects that income component, plus it reflects the amount of money that I'm going to take as a capital gain or capital loss if I hold it until maturity. So remember, how much is Tim going to get back at maturity if he buys your bond? I'm going to get back $1,000. So what that means is I will go ahead and realize $150 capital loss at maturity for purchasing your bond, which is why my YTM is lower than my CY. The CY is only 4.34. That's the income. Now we factor in that $150 capital loss at the end. That means my YTM is even lower. Okay. And then remember the YTC, that represents the yield you're going to get if the bond is called. Well, what that means is if they call my bond, that means I'm going to realize that $150 loss a lot sooner than the year 2036. I'm going to get it, say, next year or the year after, depending on when it is called. So the YTC is even lower, and that has to do with the time value of money. Okay. And in this scenario, on a bond trading at a premium, the YTC is extremely important to me because guess what? When interest rates fall, you should expect a call. That's what we say. All right, everyone. So we just have one more concept to discuss, and that is called the yield to worst. But before we go over that, let me go ahead and do a brief recap over what we have covered. So remember, our bond, Apple Inc., 5%, 2036. Well, that 5 is the coupon or the nominal yield. That's what gets tattooed in the middle of our seesaw. Now, when the bond is issued, the seesaw doesn't matter because it's simply trading at a flat line. Bonds are issued at par, they will mature at par, and then on the right-hand side, they're issued at current interest rates, so current interest rates must be about 5%. Okay, so now let's go ahead and run through those scenarios that I've given you. Remember, in the first scenario, I said interest rates had risen since this bond had been issued. We said they had risen to 7%, so we're going to go ahead and draw our check mark on the top right, and our line is going to slope downward. Now we can tell that this bond is trading at a discount because it's trading below par. I said for the purposes of our example that that discount was 850. Okay, so now we need to go ahead and stack our yields. Well, remember, never chase market calls. The N is already listed. That's our nominal yield. So now we just need to drop in the rest of the yields. So let's go ahead. We drop in our CY, then our YTM, and lastly, our YTC. Okay, so that was for a bond trading at a discount. Then in the other example, instead of telling you the interest rates had risen, I told you that the price of the bond had risen. So now we're working on the left-hand side, and what we can tell is this bond must be trading at a premium. For the purpose of the example, I said 1,150. That was the premium. So we're going to go ahead and draw our check mark on the top left, and now our line will slope downward. Now, what can we tell from this seesaw? We can tell that interest rates have dropped. And for the purpose of the example, I said 3% is what they had dropped to. Okay. Then we're going to go ahead and drop in our yields. Well, the nominal's already listed. Let's drop in our CY, our YTM, and lastly, our YTC. Okay, so that is a recap of the two scenarios that we did. Now let me go ahead and introduce to you this concept called the yield to worst. Okay, so everyone, what is the yield to worst? Well, the yield to worst is the lower of the YTM or the YTC, and that can depend on the scenario, whether it's trading at a premium or a discount. But our seesaw can go ahead and determine what the yield to worst is visually, and that's why we use it. Okay, now the yield to worst is important for two reasons. One, anytime you buy a bond in the secondary market, it will be listed on your bond confirmation. Okay, on the trade confirmation, after I buy it, it has to show me my bond's tattoo, the coupon, plus it will always show me either the YTM or the YTC, depending which is lower. So let's go ahead and figure out which is lower. But before I do that, let me also introduce to you this thing called a bond yield quote. So when they quote you a yield on a bond, what you want to know is that yield quoted is always the lower of the YTM or YTC. What does that mean? Well, let me give you an example. Here's a bond quote. Apple Inc., 5%, yielding 7.17%. Well, what does that mean, everybody? That means that the lower of the YTM or the YTC on this particular bond is 7.17%. Well, let's go ahead and figure out which bond we're talking about. Well, remember, our coupon is 5. And what do we tell you in the yield quote? We tell you that current yields are higher than the coupon. So that means we're trading on the blue line, the discount bond. Okay, so now in order to determine which one is the yield to worst, we simply need to look at our seesaw and we can visually tell which one is lower. Is it the YTM or the YTC? And so everybody, if you look, you'll notice the YTM is the lowest. Okay, now also notice the CY technically is lower, but the CY is never quoted on the yield to worst. It's always just either the YTM or the YTC. Okay, So for the purpose of a bond trading at a discount, the lower of the yields is always the YTM. And so that's what would go on your bond confirmation. And it would also be the yield that's being displayed on a bond yield quote. Okay. All right. Let me go ahead and give you one more example. Let's take a look at the other bond. We have Apple Inc. yielding 3.56%. Well, remember our coupon is 5, and now we know interest rates are lower than the 5. So we're working with this bond trading at a premium, the green bond. Now what we need to do, we need to determine that 3.56, is that the YTM or YTC? Well, everybody take a look at this bond, and what can you tell? You can tell that the YTC is lower. So that 3.56, in the case of this bond, that represents my YTC. Right? It's always the lower of the two yields. And remember when I told you on the last slide, when interest rates fall, which is what happened in the case of this bond, you should expect your bond to be called. So that is why the yield to worst is the YTC. That's the yield that I am most realistically expected to get. Therefore, when I buy this bond, that's the yield that's going to be displayed to me. Okay? So that is yield to worst. And those are two examples of bond yield quotes. Okay? All right, everyone. So that was a bond yield quote, but there is one other type of quote that you might see, and that is called a bond price quote or a point quote. So with that type of quote, and this is actually fairly easy, but it's very important because this is the most likely type of quote that you're going to receive. Well, one bond point equals 1% of par. That's what you need to know, okay? So let me give you an example. Let's take our discount bond. This bond is trading at $850. So how would that be displayed on a price quote? It would look like this. Apple Inc. 5% at 85. All right. That doesn't mean you can buy it at $85, right? Bonds are generally 1,000. 85, that would be the cheapest bond out there. What that means is 85% of par. So 850. Okay, 0.85 times 1,000, or you could just times it by 10. That's an easy trick. The only problem is don't memorize it that way, because what if they change the par value? Then it may not be times 10. So just remember, one bond point equals 1% of par. Okay, let's try it one more time with the bond trading above. Here's a price quote for that one. Apple Inc. 5%, that's our tattoo, at 115. Well, 115 means 115% of par. So we're going to go ahead and take that number, times it by par, and we would get 1,150. Okay, so you're most likely to see a bond price quote. So make sure you know that bond points are 1% of par, and you just have to times that by par to determine that price. Okay, all right, everybody. That is the bond seesaw. Those are all the concepts that I was hoping to teach you. And now let's go ahead and do some practice test questions just to make sure it all makes sense. Okay. All right, let's go ahead and do our first question. A corporate bond has a coupon of 4% and a YTM of 3.5. This bond is currently trading. Okay, so anytime I see yields in the question, I'm going to immediately go ahead and draw out my seesaw. It's just going to better help me visualize the question. Okay, so let's draw out the seesaw. Remember what goes in the middle. That would be our nominal yield or our coupon, same thing. So in this case, the coupon is given, it is 4%. All right. So now in the question, they have to either tell us the price of the bond, where it's currently trading at, or they would tell us where current interest rates are. So in this case, they tell us where current yields are, the YTM of 3.5. All right. So now we know we're working with the right-hand side of the seesaw and that the yields are lower than 4%. So we're going to go ahead and draw our check mark on the bottom, and then we would draw our line sloping upward. And from here, we can go ahead and interpret from the seesaw that the price of the bond is trading above par. Okay, so we would say that that's trading at a premium. So the answer is B. This bond is currently trading at a premium. All right, perfect. Okay, so let's go ahead and increase the difficulty level a bit here. If the market price of a AAA corporate bond is lower than its par value, well then, nominal yield and YTM are equal. Nominal yield is higher than YTM. YTM is higher than current, or current is lower than nominal. So now we're talking about yields. So again, anytime we talk about yields, I'm going to go ahead and jump to my seesaw. So let's go ahead and draw out our seesaw. Again, we're going to go ahead and start with our coupon in the middle, which is our nominal yield. And then to establish the seesaw, they have to tell us either the price or where current yields are. Now, in this question, let's take a look. Do they tell us where yields are? They do not. They don't even give us the coupon. In this case, they tell us where the price of the bond is trading. Okay, so the market price of this bond is trading lower than its par value. So that means we're working on the left-hand side. Now, everybody, where is par value? Par value is right in the middle. So if the market price is lower than par value, then that means we're going to go ahead and draw our check mark on the bottom left, and our line would be sloping upward. Okay, so now when we go ahead and do that, we can see that on the right-hand side, interest rates have risen. And now, in order to answer this question, we need to drop in our yields. So remember, the order of the yields always goes never chase market calls. So we're going to go ahead and drop in our nominal yield in the middle, and then CY, YTM, YTC. Okay, now we can go ahead and answer this question. So let's go ahead and start at the bottom. Answer D, its current yield is lower than its nominal yield. Well, that is not true. Looking at this chart, I can clearly see that the CY, the current yield, is higher than the nominal yield. Okay, the nominal is actually the lowest yield. Now, if we look at answer C, its YTM is higher than its current yield. Well, looking at that appears to be accurate. But let's go ahead and verify the other answers are inaccurate. Well, looking at B, its nominal yield is higher than its YTM. No, its nominal is the lowest yield on this chart. Okay. And then answer A, its nominal yield and YTM are equal. Well, that couldn't be possible. That would only be for a bond trading at par. So that is also not the answer. Okay. So perfect. The correct answer is C, YTM is higher than its current yield. An investor purchased a 4.5% bond to yield 5.5%. If the company calls the bond at par before maturity, the investor's return would be. Right, another very difficult question. So let's go ahead and draw out our seesaw. So we need to go ahead and find our nominal yield. Well, in the question, it tells us that this bond is a 4.5% bond to yield 5.5%. So that's a yield quote. And remember, in a yield quote, the first number is always the coupon followed by the lower of the YTC or the YTM. Okay, so we know 4.5%, that's the coupon. So that's going to go ahead and establish our nominal yield. Now, we can also interpret from the question that interest rates are higher in the market because the yield to worst is 5.5%. So now we can go ahead and draw our sloping line. And now from the seesaw, we can interpret that the bond is trading at a discount. But the question isn't asking us about the price of the bond, it's asking us about the investor's return, which is another way to reference the yield. Okay, so now we need to drop in our yields. We've already got our nominal established there in the middle. Let's drop in our CY, our YTM, and lastly, our YTC. Okay, so now what can we interpret from the seesaw? We can interpret that the YTM is lower than the YTC. So now the 5.5 that is given to us in the yield to worst quote, we know that that represents the yield to maturity. Okay, and now we can finally answer the question. If the company calls the bond at par before maturity, what would the investor's return be? Well, if they call the bond, everyone, we're going to go ahead and get the yield to call. So what that means is I don't know specifically what the return is going to be, but I can guarantee that it's higher than 5.5% or higher than the YTM. So the answer would be D, greater than 5.5%. Okay. You purchase a 5% coupon bond to yield 5.4%. What will most likely happen to the price of the bond as maturity approaches? Okay, the price will increase towards par, it will decrease towards par, will stay constant, or will drop to zero. All right, so to go ahead and answer this, we're going to need to draw our seesaw. So looking at the question, 5% coupon bond to yield 5.4%. So again, we have a yield quote, and actually in this one, it tells us what our coupon is. So let's go ahead and establish our nominal yield on our seesaw. That's going to be the 5%. So there's our bonds tattoo. Now, the question tells us that the yields are at 5.4%, which means that interest rates are higher. So right-hand side, we're going to go ahead and put our check mark on the top, and then we'll draw our sloping line downward. Okay, so now what can we interpret from the seesaw? We can interpret on the left-hand side that the price of the bond is trading below par. We call that a discount. Now, we can answer the question. What will most likely happen to the price of the bond as maturity approaches? Well, I did not mention this in the videos, but I did mention that when a bond is born or issued, it's always issued with the flat line because it's issued at par value and issued at current interest rates. Well, FYI, as you approach maturity, what's going to happen is the bond is going to slowly trade closer and closer to its par value. Because as you approach maturity, you're going to go ahead and get your $1,000 back from the issuer, and the coupon is going to become less and less relevant. You don't have as many coupon payments remaining, and instead you're just going to get your full principal back, that $1,000. So as you approach maturity, the bond is going to go ahead and trade closer and closer to par value, which means that the price of this discount bond is slowly going to increase as it approaches maturity, and it'll get closer to 1,000. Okay, so the answer would be A, the price will increase towards par. Again, a very tough question, but a great question to really understand conceptually how this all works. Okay, down to our last question. A T-bond has a semi-annual coupon of $15 and is trading at 107. This bond has a current yield of... Okay, so we're going to need to calculate our current yield, and that is a formula that I told you to memorize. It is annual income divided by current market price. Okay, so let's first find our annual income. Well, in the question, it tells us that the T-bond pays a semi-annual coupon of $15. So very important, we need to make sure we take that semi-annual coupon, annualize it, so we'll times it by 2, and that gives us an annual coupon of $30. Okay, so be very careful because in the question, they will tell you many times that the bond pays a coupon payment of $15. Be careful, bonds pay semi-annually, so we need to times that by 2. Okay, so now we know our annual income is $30, and now we just need to determine the current market price. Well, it tells us that the bond is trading at 107. Remember, that is a price quote. You can't buy a bond for $107. That would be way too cheap. So in reality, that's 107 points, or 107% of par. If par value on a bond is generally 1,000, that means 1,000 times 107% would give us the market price of $1,070. Okay, you could simply add a 0. Just be careful to make sure to memorize that that's 107% of par, just in case they give you a different par value than 1,000. Okay, all right, so 30 divided by 1,070, and that equals 2.8%. So the bond's current yield is C, 2.8.